so excited to have this chat with Doug. But before we get starting, please tell us a little about yourself, Doug.
Sure, Ed, and thanks for having me. I'm excited to be here, and I'm a very happy user of AlphaSense and the way it lets me kind of dig into the expert network and be more efficient with my research. So I spent probably 20 years on Wall Street, about 10 on the sell side and about 10 on the buy side. I worked at Citadel as an analyst, and then I went over to Millennium and had my own little pod hedge fund called Katahdin Capital. And the last couple of years, I've just been doing my own thing. I have Pitch the PM, which is essentially it's a podcast, and where I talk about high conviction ideas. I use the 10-step variant view process. And then I also have the Westport Alpha Group, which is essentially special vehicles and other sort of, small family office investments. And, I just enjoy talking about the stocks, talking about the process. And this is just a great way to kind of showcase that. I do have to say to everyone, this is not investment advice. This is for educational purposes. And I also should disclose I do own Zoom in the Westport Alpha master portfolio. And you all should do your own research and find what is suitable for you.
Wonderful. Obviously, this is for information purposes only. We're not recommending any of these investments or strategies. And let's see your investment checklist. I know that this has been something that you've shown me months ago, and I will say it is rather impressive. I am a big fan of breaking down strategies and having set rules, and I know that you've worked really hard in fine-tuning this approach throughout your career. Can you tell me a little bit about how you came about this?
Yeah, so the checklist, or it's essentially the investment process, the variant view investment process, it started probably back in 2013 for me. And I think everyone who invests or really does anything, you should really have a checklist. Whether you're a surgeon, a fighter pilot, an investor, you really ought to have a checklist. And so I started with, when I started, my first PM said, all right, you're going to go through this worksheet in Excel and answer these questions, do these math exercises, upside, downside scenarios, and fill this out. And that was his version of a checklist. And he has spent 6 years at SAC at the time, or 0.72 now. And that was kind of the process he used, and he worked directly for Stevie and for some other teams while he was there. So I started with that. And so he goes, every time you walk into my office and pitch a stock, go through this checklist first. He would review it first, see if he had questions, then I'd have to go in there and pitch it. And that's how we did things for probably the first 6 months. And then once you kind of get the process down, you understand how each other think, that you're using it, you're incorporating it into your mindset. Probably don't go through the entire process every time. And also there, you also have a limited number of names to cover. So you don't necessarily, you're more changing the thesis than doing one from scratch. So then I switched teams there a couple of years later, and now I had an associate. So when I onboarded the associate, when I went to a new team, I had to have my own checklist when my associate pitches me stuff, what is my process for that? And I had to tweak it because my new portfolio manager had different risk requirements and volatility thresholds. And then again, I tweaked it again. Then I went to Millennium, or Katahdin, which was funded by Millennium, and I had to hire a new team, people starting from scratch, and they had their own habits. They came from other firms, Balyasny, 0.72, and I had to make sure that they were on the same page with my process and what I wanted to see, so that I could trust that they've done the work. It's also a way to keep people accountable. And then, that process morphs by sector. And then again, when I left, the variant view checklist, this is now another unique checklist that I created just when I started Pitch the PM, when I started to talk to analysts and said, hey, let's talk about an idea, let's put it through a process and put it on a show. So that's kind of the history of it. And it's kind of it's always morphing based on, other things that I'm learning. I actually have a separate checklist, what I call the Berkshire checklist. That's not really geared for hedge funds, but more of a long only view. This is obviously geared towards hedge funds and forward estimates and how are you different. Whereas, Berkshire Buffett never looked at forward estimates. He only looked backwards, and at least for numbers. So you have a little bit of a different, simpler checklist. So yeah, and it's actually, this is 10 questions, but there's actually an Excel behind it that has 60 questions. So you don't answer each one every time. But anyway, that's the checklist, and that's what I like to go through when I hold myself, me accountable to doing my work.
That's great. You definitely have quite the network. And I will say I've started seeing some of your past appearances, and I really enjoyed your debate, which you had a few months ago with, I believe, one of the top shareholders via portfolio weight of Zoom, Sean Emory. And I wanted to say that fascinating I think it was like over an hour chat you had, but definitely interesting. And I wanted to get a sense of what are some of the signals, though, that you look for in a company before you do your deep dive and you try to learn more and do all your research.
Yeah, so now, I think it's a little different. When I was in a more structured environment at Citadel and Millennium, it was only, these are your defined universe, or your defined sector. So it had to be there. Now my process is a little bit broader. I'll look at anything in the sectors that I know well, which is, tech, consumer, energy, industrial. That's the first thing is, do I understand this? Have I used the product? Because you can't really expand your circle of competence that quickly. It happens slowly over time. Now I'm at a couple sectors because it's been 20 years, but I'm not going into financials and healthcare really personally. And then the next thing I'll kind of look at is, because I'm always talking to friends and colleagues about, we're just always talking stocks, like Sean and other folks. What do you like? What don't you like? It kind of comes out. People give you one or two sentences, but then you kind of got to go through the checklist. So what I'll look for is first, what's the, call it earnings per share, but there's so much noise with that. I kind of bring it down to unlevered free cash flow. Like what's the essential price? What's the cash on cash? Plus the growth rate, and say, hey, is this reasonable? I'll try to, maybe I'll pull up a chart and look at it. I don't really want to buy something that's making all-time highs. The story's growing 20% a year, and people are like, how many years, what's the TAM? They could do 20% forever. Those stories aren't for me. I want to kind of generally look for something a little bit more beaten down, a little less popular, not really on TV or being talked about a lot. So then, do I understand it? Is it reasonably priced? And then I kind of look for something that's, what's going to change it? Why is it beaten up? What's going to change? Why is it going to go from 3% growth to 5 or 6 or 7? What is there technology? Is there a culture? Is there something that's going to change this value to change the future perception? And how do I go about, is it something I can research? And then can I logically make a bet to say, hey, it's most logical that if they execute, then this stock will be worth that. And what's the probability versus the other sides? And it's a great question because it takes a lot of time to really diligence the stock. So you don't have time to really, the 20 stocks you're going to research in a year, how do you get to those 20 that you're really going to dig deep in versus all the stocks you end up coming across and are pitched superficially, at least.
Awesome, great. And let's get started with the rest of the slide deck. Right now, it's titled, Do I Understand This Business? I know we're going to be covering a lot. We're going to have a lot of metrics, but which valuation metrics do you prioritize, and especially in today's environment where we've seen excessive volatility from many macro reasons?
I take everything to free cash flow. That's just kind of the cleanest way to do it. Now, again, when you look at free cash, there's some other things you have to look at here. For example, there's a lot of stock-based comp in some stocks, and you get the cash for it, but then you got to, nick them for the dilution. And then, so I'll look at unlevered free cash flow. That yield is kind of how I think about it. So you can look at it, the risk-free is 3-4%. The stock's yielding unlevered free cash 7-8%. You could get into riskier assets, small companies, et cetera. It could be 15, 20, 30%, yields or returns. I kind of, and in theory, the earnings yield should be the unlevered free cash yield. It's just not always the case because there could be noise of D&A or stock-based comp. So this one actually benefits on the unlevered free cash yield because the stock-based comp is added back. And, that's up to $1 billion. I think it's going down to probably 400 or 500, 10% of revenue. So yeah, that's what I look at.
Thank you. And I know with the Zoom, I think the first thing people think, the pandemic, they think about that explosive growth. It seemed like for, several weeks we had everyone talking about it. Even CNBC would bring on NBA basketball players saying what they're doing with the stock. What, I guess, kind of intrigued you specifically about Zoom? And if you could kind of discuss that chart that you also have displayed.
So Zoom is a name that, I use it. I've used all their competitors on a daily basis, so I feel like I understand it a little bit. It's obviously in the enterprise software business as well, and that's a separate channel. And I also understood the COVID work from home darlings that got kind of spit out. So I did investor relations for a company called Fiverr. It was a very similar story where growth went 70, 80, 100%, and then kind of came down to 0, low single digits. Same thing here. And you can see here, the year-over-year growth, was a couple 100%, and now it's kind of low single digits, and the stock price essentially moved with that because people tend to capitalize the growth, thinking they could grow forever into their TAM. And now you don't get a lot of attention for Zoom. And one of the reasons is they have an online segment, which is kind of a self-service segment. They don't really have sales, and everyone signs up for Zoom, small businesses, individuals. And when the work from home, people, the growth really slowed. And then also customer base has a high churn, a couple percent a month, whereas enterprise software is typically very sticky business. So it's much higher quality on the enterprise side versus kind of this self-serve online segment that everyone in Zoom kind of knew. And now that that online segment's down to about 40% of the revenue, and it's should be stabilizing. It's kind of stabilized here recently. And then the growth from the enterprise, which isn't just Zoom video, it's phone and contact center, and they're really best of breed here. That's been growing pretty steadily as well. The other reason that I'm interested in Zoom is if you look at kind of the R&D line, or you just read all the transcripts on AlphaSense, they're really best of breed, and they're really investing in new products and technology. They've taken a lot of folks, senior folks, their CTO from Microsoft, and they're just focused on becoming a unified communications platform versus just being a product company. When you do that, you get a low pricing, you're a lot stickier with your customer, and then you get a higher multiple once you start growing more. So yeah, at the end of the day, I felt comfortable enough to use it and to understand the business.
Let's head over to the next slide. I know that everyone knows pricing. Is it reasonable? I think in the current environment we've seen, it seems like yesterday the NASDAQ was in bear market territory, and then we have escalations, de-escalations in this trade war. How does your strategy though? Does it change when valuations across Wall Street no longer reflect the underlying realities? Do you just wait, or what's been your approach, especially over these past several months?
So you start with kind of the bottoms up fundamentals. I'm not really smart enough to get the macro right. There's way too many moving pieces that I can't reasonably forecast. So if you understand the company, and yeah, I mean, and I'm not going to predict when there's a recession, but the enterprise customer shouldn't really change. They're not it's software. It's not really necessarily being coming on a container ship, right? So from that perspective, their outlook doesn't really change, right? So I kind of just look at it, hey, is this really going to change their growth or their cash flow? Now, what happened with the federal government and the layoffs and the seats, that might have a tiny impact. I think that might be transitory. And maybe their customers say, well, push off decisions on add in this service or whatnot. So it could impact them. I don't think it's going to change the thesis that these guys are an AI first company. They're the ones who are going to use AI to add value to their workflows and really embrace it to add the value and save people time and productivity. That's kind of the core here. My mindset is who's going to benefit from AI. It's the people who use it to add value for their customers. And I think Zoom fits in that growth. So how did I trade it? I actually put out a poll, and even what I was doing. Essentially, I first said this is posturing. It's obviously volatile. It's emotional. So I said I wasn't doing anything. At the very bottom, I maybe trimmed 5%, just in two positions. And then I said, all right, this is posturing. And then I said, all right, I'm adding now because I think things are cheap. So that comes into the valuation. I mean, Zoom at a 4% yield versus a 10% yield. At 10%, I love it. At a 4%, less so. But I'm initially underwriting it at 8%. So plus the dilution. So I felt, I do think you have to, if the macro changes your thesis. So the other thing that happened there in another part of my portfolio was oil. Obviously, there was an OPEC announcement too. And that I did change my position in there because that was macro, but that was also a fundamental change. It so happened to be at the same time. So I'm not opposed to changing positions on evidence. I try to underwrite stocks initially that where if you have something like, hey, I need a macro GDP growth or something to happen politically, that's a whole nother investment or bet that is really outside of my scope to make.
And that's been very difficult, especially the last couple of years.
Absolutely.
So with Zoom, I think a lot of people, when they take a look at the historic highs, 500 or 600, and then back to reality, it seems. Your slide is titled, "Why is the stock mispriced?" Can you go over exactly what the key drivers are for that stance right now?
So there are a few reasons why I think Zoom is mispriced. So one, their EBIT, so this is adjusted EBIT, so I back up the stock-based comp is in green. It's roughly the same level, if not a little bit higher than it was during COVID. And the other things I'll show in this chart are the red line is the enterprise, the red bars is the enterprise growth has been growing steadily. And then the pink is kind of the online revenue, which is declined and flattened out. So I think the declines in the online segment has really masked the total growth of the company. It's been flattish more than declining. But now that, the enterprise segment is getting to be a larger piece of it, they still have great free cash flow. And I think it's still, the profitability is there. Why is the stock down, 4 or 5x since COVID if the profitability is higher? People don't really love the online segment versus the enterprise. It's kind of enterprise segment. It's higher churn. It's lower visibility. Obviously, the segment itself, you're competing with Microsoft essentially and Google. So from a high level, that's something that people don't like, right? How are you going to win versus these big pocketed companies that are already entrenched with the customer? But when they already have, they're keeping the share. When you look at the Okta surveys, you look at other things, they are still growing. So from a high level, yes, you have some concerns, but we look at the bottoms up checks, they're holding their own, and even more is the key there. So I think the profit's underappreciated, which gives you a nice kind of base. And then the key is what's going to change it from here. It's really the growth, right? If this goes from being a kind of 2-3% grower to being a mid-single digit grower, it'll get more credit. So you're saying it's reasonably priced now, and there's a reasonable path that at some point it gets to mid-single digit growth based on all this product innovation and what we're hearing, and the new things they've introduced, like phone in 2019 and contact center, where they just had a recent partnership to kind of expand that with ServiceNow, and just the quality that they're bringing in, even with the AI, makes you feel reasonably comfortable that they're going to be able to make, at some point they'll have better growth. Obviously macro, whether it's, federal employees or other things, can impact the timing. But if you win on the technology, you'll ultimately win.
We do have a question. It asks about Zoom's competitive positioning versus Microsoft Teams, and about Zoom's pricing power given the alternative offerings. Can you provide a little bit of I know we cover a lot throughout the presentation, but can you kind of address, the big giants that, Zoom is facing?
Yeah. So, Teams, it's somewhat included there. And, on the video side, I would say that the thing that's really changed here is now with AI, Copilot, now they're charging you for. So now Microsoft is actually charging, it's included, but there's something else they're charging for. With Zoom, you're getting this AI for free. They're not really raising their pricing. They're just giving you more products, whether that's, the calendar, the whiteboard, the IM Slack services, so they're giving you more services without raising the price. Because right now they don't necessarily have that as much pricing power, because they're not as embedded on the enterprise. They're like, hey, you're the product. But once you get in and you're connected to the phone and the contact center, and your AI notes are, connected into other workflows, that's when you get pricing power. So yeah, I mean, and there's some other arguments in there, whereas this is easier to use, where you have less strain on the IT department internally versus Microsoft Teams, less onboarding and structural costs. And Zoom even talks about having some customers boomerang back once they switch off, because it's and you'll read in some of these transcripts, people will, right after the bubble kind of popped, the work from home COVID bubble, there were a lot of tech companies saying, all right, company I worked at, 5 or 2 was one of them, they all tried to say, we've way too many subscriptions, way too much tech, where can we cut? And some people tried to cut Zoom, and the sales force pushed back, because if you're making a sales call, you want the best. You don't want to have to, mess around and have fumbles. So yeah, there are definitely some people who say, I don't need it, you can settle. And that's why Zoom is trying to say, well, we're giving you all these other things now. So you actually, on a total cost basis, if you use, our kind of Loom-like product or other products like chat for communication, it'll actually be cheaper. So yeah, there's definitely competition. But I think at the end of the day, you look at what you're seeing in the channel, and you're not seeing Microsoft taking the share. I think it's because Microsoft's so big and they're so focused on so many other things, right? If you look at a big company, there usually is 1, 2, or 3 things that they focus from the top level that are really going to move the needle. So, that's probably cloud, AI, Copilot. How much are they really focused on all these smaller things that Zoom is focused on day to day? And I think, be working in a corporation, you kind of realize there's certain projects that get every resource, and at Zoom, these are the projects. But at Microsoft, this might not be the investment, thing that they're really focused on from the top level. So, you do have a history of founder-led companies sometimes who are super focused, who can win on quality. And I think that's what's going on here. It's one of those intangibles. Again, you pick it up from some of these expert networks of seeing who's coming over from Microsoft and the culture and such.
When we were discussing this webinar, there were so many slides we had, and we had to, cut off a few. One of the ones that didn't make the main presentation was I understand this business. And I thought it was great because I did not really know about Zoom Phone, the contact center, and it truly is something that, you have to understand all the revenue streams. And I wish Zoom would break it down in their earnings. But I think you pretty much highlighted here nicely just some of the differences and more importantly, how you got the information.
Yeah. So they launched Zoom Phone in 2019, and both the Zoom Phone and the Contact Center in 2022, and those are both growing faster than Zoom Phone. But they also they have pull through and they have attachment, and Zoom Phone is also competing with infrastructure, copper wires and stuff, and it's a lot cheaper from that perspective. If you can have the phone attached to that, and it's also more seamless to communicate with your kind of Zoom meetings and such. So phone's definitely a place where you have a value add proposition for the customers, and that's one of the things where you talk about being an ecosystem and a unified platform versus just offering a product. So that's one of the more exciting growth areas is Zoom Phone, and because it saves the customer money, right, versus all the legacy infrastructure. So it's funny. When I worked at a tech company for a year, we didn't have that Cisco phone right there on our desk like we did kind of at all the on Wall Street per se, but there was only one landline in the entire building, and that was for earnings calls. Everything else was on the cell phone, whether it was Zoom or WhatsApp. It was so they're kind of leading there, and there are other people who do kind of the phone next generation call technology, not copper phone. So that was one, and then the contact center again. Those are bigger, chunkier products where, companies now, you can get in touch with the company through a chat, through a phone call, and then, that's all kind of coordinated into one area. So it's just all your, communications. And that's, I think that announcement with ServiceNow just kind of validates that partnership is kind of going to integrate with Contact Center and how they go to market. And, why not integrate with the best of breed sort of. I think it's well known that Zoom, at least their video and their noise cancellation, like the quality is the best. The question is, do you want to pay for it? And I think to some extent we had that tightening of the belt coming out of COVID when all the tech companies had to switch from growth to margins and they went through their tech budgets. So I think we kind of shook that out.
Awesome. Let's go back to the checklist. We are looking at, let's see, the variant view versus street view. I think this is one thing that, a lot of people, they just jump on the consensus, and sometimes that works really well for a long time, and then you get blindsided. What are your thoughts on how you approach this?
Yeah, so I think the variant view is essentially where does the rubber meet the road in terms of the numbers or the multiple. What are you really betting on that's different than the street, and how are they going to get to your point of view? So sometimes you'll try and quantify that and do a bottoms up and have a different number. So one, I think, the company, the online segment, it appears to have stabilized historically. The company still said, and I was surprised on the last call, maybe it was conservative, maybe it wasn't, new CFO, where they said it was still, flat to slightly down. And there's also a new head in there for the last 5 months. And again, it's a product guy, the product focused company. They're going to try and focus on how are we converting the unpaid to the paid, at least in the online segment. Now I pay for it, but before I had to pitch the PM, I was using Zoom for free, right? 45 minutes, it was fine. So that's one thing. So if that could help keep the online not even down or flat, but maybe grow a little bit. Then the other side is on the enterprise, you kind of see what they're doing with AI and the automatic transcripts and how you could use, how much more efficient that makes you. You could use that in other workflows. Once you have that, other people on your team can have access to that. So if you miss a meeting, you come to a meeting late, you kind of know what was happening. So yeah, I think that's the fact that they're using AI, they're on the leading edge of that. And that's who they kind of took. Their CTO, was CTO of the Microsoft, cloud and AI part. So you could kind of see that they're doing things first and early. They're a leader there, and I think that'll pay dividends. And then you kind of go to this, one of the intangibles again of the culture, founder led. This is what they're solely focused on, and that's a bet you want to make. You're betting with people who are highly motivated, highly skilled, and aligned. It's not a third generation CEO of a mega company that has 5 other big projects. And you've seen their innovation on the product side. And they have to win by being the best. That's the only way they're going to win.
Great. I want to make sure we get through the entire presentation, so we might have to go a little bit quicker. The next slide, I know that the variant view, and I want to make sure that we really touch upon, some of the tools that you use to get that variant view. I know you have lots of evidence. This one particularly stood out for you. Can you go over how you came about it and what you like about it?
Yeah, so I mean, you're doing a lot of background. You're reading Ks and Qs and transcripts and talking. Now you can there's a library of expert calls by date, which is super helpful. You don't have to kind of set them up yourself or go to conferences. All the research is kind of right there, which is super helpful versus when I started and have to go to a trade show and find people at lunch to talk to or whatever. So yeah, and you can see some of the work in the back. Like some of them are just background. I learned a little, but this one I thought was pretty salient because part of the thesis is, all right, the Zoom phone opportunity, right? That is a big opportunity. That's probably 10, 15% of revenue already. It's in just a few years, it's growing. They're able to attach through it. But this was one example where an enterprise customer, they were spending Zoom for Zoom, the video and then the traditional meeting. Then when they added Zoom phone, now they're spending 500 because it touched a lot more seats and everyone needed it. So I wanted to validate my thesis of what can really be the impact of Zoom phone. And this is just one anecdote that you're able to kind of gives you part of the mosaic, the conviction that, hey, this really is working. Here's one example of it. So that was one. And it's just, again, it's super convenient just to have those transcripts there, and they're updated. There's a couple new ones sometimes every month, depending on the name in the libraries.
Are you surprised more analysts aren't more optimistic on the stock, given all these additions to make it a full UCaaS suite, unified communications as a service?
I'm not, because I think the growth rate's really low. And right, the headline is you're competing against Microsoft and a little bit of Google, and there are other players out there in some of the spaces, Five9, et cetera, and Ring Central. And the growth rate's low. I mean, people, and it's been stable. It's not like it's gone from 0 to 3. I mean, maybe it's gone from 2 to 3 to 4, back to 3. Like the street will say, all right, once then we're a little bit more reactionary. Once they start demonstrating 4, 5, 6, 7% growth, then you'll see potential upgrades. Are they getting traction? They want to see it in the numbers first, whereas I want to be a little earlier. And try and say there's a likely chance that we're going to see it in the numbers based on what they're doing. If you look like their R&D budget's going up, they're starting to expand internationally with partners in the channel versus doing it all themselves. So yeah, I'm not surprised. It is mostly hold rate-ins, and it's not and it also has this online segment which has churn, which if you look at the rest of the enterprise segment, they don't really have that. So I understand why people don't want to underwrite that, but because it's a little more volatile, but it could be more volatile. It hasn't been, but the cash flow is still coming from it. It's still stable. It's not like it's fallen off a cliff, but there's a little more risk involved with that, at least on a perspective, even though I would say it's been stable. And yeah.
In this case, do you believe though that, the reason for the churn, they're trying to keep talent? Is that a justified reason for their stock-based compensation?
Yeah, so I think, it comes back down to the culture again. So the company has very high stock-based comp, and that's actually something that's not good. I mean, it was almost $1 billion. It's, almost 4% of dilution a year. It's going to be coming down. So what happened is they had a lot of people, in tech, things were competitive. They'd give you your base salary and then whatever they needed to give you in stock-based comp to get you to come over from wherever. And it was a talent war. Your stock-based comp is based on the price at the time. You think the stock's worth a couple $100 and all of a sudden it's not, but you don't want your employees to think they just got, a third cut. So what they did is they topped them all off to kind of make them whole. They gave them more equity. This is a company where if you actually read, I've never seen this before in the K, like their mission is for people to be happy with their product and their employees to be happiness. It's literally happiness is their mission statement. They gave more equity, and I get it, because if you're telling someone they're going to be making, let's just say 300,000, you give them 200 base and 100,000 equity, and all of a sudden that 100,000 equity is now worth 30,000. They they're going to be a little annoyed. So they kind of made them whole. But they've also addressed this last year. They put out a statement to employees like, hey, we've gotten the message from shareholders and we're going to be reducing our stock-based comp. And the question is, do they give cash instead of that, or is it just lower comp in general in tech? So we'll have to see how that plays out. I mean, hopefully my expectation is to get the stock-based comp down to under 2%. Ideally, I'd like to see it, like they have such a balance sheet, I'd like to see the share count go negative, decrease with all their free cash and their balance sheet. There's really no reason for it to be growing. I mean, this is a problem in all of Silicon Valley companies. They all they're all dilute. Not massively. There's too much dilution. I think when you make the transition from private to public, when the growth slows, you got to realize that public shareholders want to use your money to return it, especially at Zooms. If you believe in the growth, it's a great time to be buying back the shares. And they have $7 billion, $8 billion of cash on the balance sheet. They're still making free cash flow is still, $1.5, $2 billion a year. Call it 1.7, 1.8. There's a lot, and they've been using some of that cash to offset some of the dilution. I'd personally like to see them do more.
All right, so let's go to the next slide. And I guess these are some of the key reasons why you like Zoom. You focus, it's always about growth. Can you break this down for us?
Yeah, so you might have a variant view that you think growth's going to pick up at some point, but all right, what is the path to getting paid? What are the catalysts that are going to come out that help everyone else realize what it is you think you see or your research has uncovered? So one is just the enterprise traction, right? By integrating phone and contact center and the other products. That's the core business and the thesis, and that continues to grow. And again, grown internationally with other channels. I don't know when that shows up, but I think that's the key driver here is investing in. And you look at it, you can kind of see how much they're spending in R&D, right? They've also made a change in the head of online segment, and I kind of analyzed it, thought it was pretty stable. I was surprised that they kind of guided to flat to slightly down. And then, the new head and the strategy to focus on getting unpaid to paid. Well, if you're doing that, why wouldn't it at least be flat to up? So maybe there's a variant view there for a little bit more upside. Again, execution is key there. And then, there is some data, near term. I think I try and make a thesis that's more durable than any given quarter. The quarter is more of a proof point or a signpost on the trail to make sure your thesis is on the way. But there is some data out there suggesting pretty solid. I think the street's at about 2.2% for the quarter. There's some data out there suggesting 3 to 4, 3.5, 3.7% growth. Now those, what percent of the total pie, how accurate what you can do to kind of reconcile that from kind of these third-party checks. So that is out there that you could start seeing the evidence. At the end of the day, you're going to see it in the growth rates, right? I've seen the transcripts are good, the channel checks are good, the third-party data is good. They're invested in R&D. The question is, when do you see it manifest in the revenue growth? It could be this quarter. I think it, likely it could be but I don't know which quarter it will be in. I don't have a crystal ball. You never do. But if you have a thesis, and when it becomes a question of when or not if, that's usually a good thesis. And then, you have a new CFO too, right? I think I was a little disappointed last quarter, at least when they guided to kind of 3%. I thought it was kind of trending up to 4%, and then they had some FX. But given this macro, why are you going to kind of put it where you think? Why not give yourself a little bit of room? So that's just my interpretation. And the companies traditionally, if you look kind of, they've always beat by a little bit. Yeah, those are kind of the catalysts. At the end of the day, you have to see it in the revenue growth, and it's going to have to be over a couple quarters. You're going to have to see them not bouncing around between 2, 3, 4 back. You have to see the real growth coming into the mid-single digits. I mean, they're announcing big customer wins, Fortune 15 wins. They're announcing big contact center wins. They're, traction with Zoom Phone. So, they're doing a lot of things right, and it's just a question of when we see when do we see it come through. That's trickier to forecast, but you see kind of the right steps and the right ingredients going into it.
And we do have a question, and you kind of talked about earnings next week. Obviously, everyone is going to be paying close attention. Do you have any thoughts on it? And are also another part of that question was, do you have any real-time indicators on how performance has been trending?
The answer is yes. There are some indicators out there that, like I mentioned, are tracking in a little bit north of 3-ish%. When I talk to the company about these indicators, they say, they're hit or miss. They're not really accurate. They're not necessarily representative. So they tend to de-emphasize all these, whatever they are, credit card checks or other channel checks, because they don't see the whole, it's a tiny slice of the pie and you're extrapolating it. But so far those look okay. That people, those are also, if you're a company, you don't want people now to have a higher expectation than what you've said, because then you might have a good quarter and then all of a sudden your management team's like, hey, why is my stock down? And, you only have the CEO, CFO's attention for like 2 days during earnings. They want their stock to be up on earnings. And then they want to, send good reports to the board. They don't want to be confused. So you don't want to get expectations too high for a quarter. And there's definitely been a little bit of color out there that it could be, a percent or so better. And then even if it's better, does that lead to an upward revision? Because a beat without a raise, a beat and a maintain doesn't really do the trick. You need a raise. And I'm not to say a new CFO or someone's going to really raise this early in the year. You might want to see a second quarter, given the macro, given what's happening with the federal government. So the good thing is I don't have to count quarters anymore. I have a thesis that's more durable, and I don't know which quarter it's going to play out on. And I also have valuation support. So I know that there's value here, right? Based on the cash flow, based on stock-based comp coming down, and just the rest of the groups at 3% yield. Obviously they're growing 15-20% the rest of the group, but other strategics see the same numbers I do, right? You can run you don't have enterprise software names in this sort of valuation. So yeah, I hope that answers your question. Like I said, I don't have to make quarterly calls anymore. I do track them, but I do try to have more durable, concentrated positions. So you got to do what's good for your strategy, I would say.
No, completely. This is one of my slides that I wanted to really do a deep dive with you. I know that you have your opinion, you act on it, and then you try to assess, what's the other side of the bet, what is worth if you are right. So why don't you kind of highlight what you do and how you approach this?
Yeah, so I try and make it pretty simple, but you should try and quantify, like, all right, I think the growth rate is going to accelerate. If I'm right, what does it actually mean? Try and put a little math to it. And what I do here is say, all right, right now, the company's growing, call it 3-ish%, earnings yield, levered free cash. So I kind of value the company, and then I added the cash back later and the strategic investments, et cetera. And then I said, all right, well, let's say the growth right and the growth accelerates. So I grew the adjusted net income, which I'm essentially calling free cash, CapEx, DA, all that. And then I'm taking out the stock-based comp as dilution later on. So I'm just growing the growth rate. And then as I'm doing that, I'm saying, well, your value proposition kind of stays where it is, this 8, 9, 10% range, where then your yield's going to come down. So you're getting to the same point. So the 3 plus 8 is 11 minus the dilution of 2.5 on average. And then you go out in the future and say the growth is there. You're still going to get 15-20% growth from the adjusted net income earnings growth, but more of the value is going to be created from the higher growth rate and the yield essentially going from called 8% to 4%. If people are going to willing to pay more because they believe the growth story. So that's how, this is just the math that you get. And, it's an illustrative example, but you can see the stock, going from 80 to call it 150-ish. And I still have dilution in here about 2 to 3% a year, which I ding them by, but it's just a simple way the way I illustrate, it's just the way I think. Companies generally think you should get call it 10-ish% return in a large public company. Growth plus free cash should kind of get you to your expected return. Dilution is something I usually, you have to add in for these tech guys. Just, 4% now, hopefully going to 2.
Getting talent is expensive, yes.
Yeah.
Very much so. And on the other side, what's the other side of the bet? And, hopefully it's not this.
Well, yeah, hopefully not, but, I don't know the future. No one knows the future. Making a calculated decision based on what I think is priced in, which is 3%, what I think is likely that it could go higher. So, but there's a chance I'm wrong. I don't have a crystal ball, and you have to at least acknowledge that chance and put a probability on it. And, here what I'm doing is just decelerating the growth rate, which impacts the net income, and, down to 0 to -1. And the same sort of thing. Whereas if you're a company that's not growing, 0% growth, you might want a 10% free cash yield. So I have the yield going the other way. So again, it comes out to about 11% total return minus the dilution of 2.5 gets me to this 8.5. I kind of kept that constant. You do the math on what it's worth, and you can see the stock going down potentially 20-25%. So if there's less growth, you're going to want the valuation is going to go down a couple points on an earnings yield basis. That's not my base case, but you have to at least understand what the downside is. Now, the good thing is the balance sheet is 7-8 billion of cash. So you're essentially buying a third cash when you buy this stock, or maybe it's optionality. I'd like to see them buy back shares. There's things that they've looked at in the past. They've looked at 5.9 in the past. There's some other smaller stuff they could do, but again, they want to be a fully integrated platform. I think with AI, the key to winning is having access to everyone, the most data. And for Alpha Center, you add that library, it's huge for me. If you have the internal notes transcripts, that's huge. You add in the IMs and then all the other workflow, and whatever AI can access everything and put it together is really, that's going to be super important. So yeah, there's always downside, right? Technology, it changes fast. I don't know who's going to win. I'd like to think I'm betting on the right horse, the focused horse with the right culture, but there's always downside in investing.
No, very much so. And one thing with the platform I really love, I'm always trying to find the disruptors, and we have so much private company information data, and that's where you could maybe find a small video conferencing or small company that might be good for takeover or might be a threat to their product and more importantly their pricing and big impact on their margins. So definitely it's like the research never stops. It's always going. With step 10, you have this one. You're focused on management. Are they aligned with the company? And one thing I wanted to also know is, the culture. We've talked about it briefly. How do you assess the depth and quality of what Zoom is doing, and more importantly, their innovation?
Well, so are they aligned? I kind of gave this one a mixed rating. When obviously the CEO owns 78%, founder led. We talked about that. He controls over 30%. There's AB shares with next voting, which so he does have control. But then the other part of it is the dilution. Like I mentioned, that's not shareholder friendly, giving away that much equity. But if you have a culture of happiness, that leads to innovation and winning. But you have, how can you do that and not dilute your shareholders so much? So I think you got to get the share count going the other direction. Yeah, are they aligned? You could say they are, because they gave when you give equity to your employees, they're aligning them to the company's success, which is super important. And there are a lot of people who believe in giving equity to many layers of the company, which is a good thing. It motivates them to work harder, and certainly no one wants to feel like they're getting a pay cut, which is what was happening after COVID with the stock price. But shareholders had a different view versus what the management obviously went with the employees over the shareholders on the dilution. Company, founder-led company, they can do that. I think they got the message not to do that anymore, or to kind of offset it. I mean, they have enough cash on the balance sheet to offset it. They were super smart. They issued $2 billion of equity in, at 350, 360, and maybe 330. I don't remember the number. Somewhere in the 300s in 2021, at kind of close to the peak. So they're pretty smart capital allocators. They haven't done bad acquisitions. They're too pricey just for strategy reasons. Like, they are smart because they own, he owns a lot of it, and he wants to make the long-term bet to focus on the employees, because if you're going to win by innovation, because you're competing with Microsoft, you need to keep the employees happy. He's got to find that balance. That's the hard job of being, I guess, the CEO is, having your shareholders want less dilution, having your employees want more stocks. They got to kind of balance all of that. And at the end of the day, the culture is what drives the innovation and the sales, and that's what leads them to be that much better over time. Is you have to innovate in tech, otherwise people get complacent, and the pace of innovation is so fast these days. You really just don't know what's going to be out there, what's the solution, especially with AI now in 5 years or whatnot. So you really got to get in now, get on. This is like the time with AI where you really need to be innovating and incorporating it to win now. Because if you're not getting on the client's real estate and on their screen and in their workflows, you're not going to be able to implement the AI. And ultimately charge. I mean, they don't charge for AI; it's free for them. So they're just kind of giving it away because their other businesses are really good margins.
Great. Well, thank you, Doug. We have quite a few questions. We have about 5 minutes left, so let me try to get through them as quickly as possible. One of them is, you make a lot of use of the AlphaSense for product assessment, but presumably you also use it to evaluate management. Do you also have a checklist for evaluating management, and what are the key things you look for and to measure?
Yeah, so there's a bunch of things. One, I mean, historically, you'll want to look at, how are they incentivized? Show me the incentive, I'll show you the outcome. So Are they getting performance-based units, RSUs? How much are they? What's their capital allocation history? What's the return on capital? This management team obviously was smart about issuing equity. Look at their past, right? They issued equity really high. They walked away from deals that weren't good. I'd like to see them do more buybacks, but they're focused on product and innovation, which is, so the checklist for management, it's funny, when I was at more of the kind of faster money places, we would, cover these names, and every stock had an alpha curve, and it didn't matter what management did. You needed access to them. So you kind of had to play nice. Now, you really want to be aligned if you're going to be a long-term shareholder. So, it's kind of their reputation, their integrity, and then their historical actions. And also you want to look at, again, how are they being incentivized? Are they just giving themselves a lot of options? Are they getting paid for outperformance? Are they taking pay cuts, or are they just giving to their employees? So you look at all of that. But yeah, again, there are more issues, with management incentives and what do you look for? But I guess some of it's hard numbers, some of it's intangible reputation stuff.
Oh, great. We also had a question on this year. Has anything happened that changed your mind on how this year will be for Zoom?
This year, it's a fair question. There's kind of some good things and some bad things, and nothing's really swayed me. I think the near-term kind of channel checks and when you look at the street at being at like 2.2 for the year, and the rest being some channel checks and a little over 3, that's obviously a positive. When you kind of mark to market Q1 for that kind of small speck of data, that's a positive kind of signpost along the way. The macro uncertainty, that's not good. If people are hiring, they're not adding seats. The uncertainty from all the trade stuff is not good. And then obviously the layoffs for the government agencies, again, those are seats. This is, this company, to some extent, you charge by seat. So that's a headwind. So yeah, you have some positives. Things are tracking as expected, but there are some macro headwinds. But given my thesis, like I said, I'm not going to get too worked up about anything in the macro, but that could be a reason why things are fine near term, but then they might be a little bit more hesitant until they see it in the numbers in the future. Like I said, it could be a beat, beat and maintain sort of thing. But I don't get too worked up on quarters anymore, which is good.
Oh, that's great. I completely like that. I think we might be able to squeeze in one last question. You have about a minute. For a stock that had been historically high volume in the past, if you were still at one of your old shops, would you think about an appropriate hedge for a long position, and how big would a volume position be like this?
So kind of two questions in there on sizing. I mean, this name is pretty liquid, so I don't see really any issues with sizing. You can make this $5, $10, $50 million position. Call it, if you call it $1 billion book, whatever, that's 5-ish%. I used to size on percent idiovol, not necessarily just GMV. So you see how volatile this one is. This one's not as volatile because it has a lot of cash, lower beta. And then how would you hedge it? So I would probably have this, you could do it. Usually I would have like an enterprise software, like Subbook, and this would be, if I had 3 or 4 names I like versus maybe 3 or 4 names I don't like that are alpha shorts, or maybe if I didn't have an alpha short, I'd take a basket of enterprise software names that are highly correlated, run things that are highly correlated against it. You can use an ETF. You can do a custom ETF. Ideally, you'd have an alpha long and an alpha short, something where the streets may be expecting 20% growth, but your research makes you concerned they're losing share, whatever, a high flyer that's not going to be a high flyer. So you could, ideally, so I'd run it in kind of a sub-segment book in kind of enterprise software, see what's highly correlated with it. I'm trying not to, run with kind of hedges for hedges sake. I kind of only put on positions that I think, one, they have downside protection, right? There's not a lot of growth priced in here. There's a lot of cash, some cushion, and I do believe the products are good, and at some point we could see the innovation. They're also best of breed at what they do, and I like being aligned with management. So that's kind of my thesis on it. And again, I do think a lot more about how could I be wrong, and if I'm wrong, how much could I lose? Because it's it's not you're not playing with the house's cards anymore.
Great. Thank you very much. So sorry, but that's all the time we have today. Sorry if we did not have a chance to get to your question. As Wendy mentioned at the beginning, you will receive the recording within about 24 hours. Doug, thank you. As you can see, with a slide up talking about the host, Doug Garber. You can see him on Twitter, Pitch the PM. Thank you so much, Doug. Thank you, everyone, for attending, and Have a great day.